Welcome, curious minds, to another deep dive. Today we're tackling a genuinely high-stakes topic in the world of stock investing. We're doing a deep dive into American Airlines Group, Inc., ticker symbol AAL. We've got a stack of detailed analyses here, financial reports, industry insights, and, well, our mission is to cut through the noise, clarify the complexities, and really arm you with what's truly important if you're looking at this airline as an investment.
Exactly. And this isn't just about understanding an airline. It's a compelling case study in how a company's financial structure, particularly its debt, can completely reshape its investment profile. What's fascinating here, I think, is that American Airlines presents this classic high-risk, high-reward scenario, almost like a financial riddle waiting to be solved. We're going to unpack the often opposing viewpoints on its potential and ultimately distill a clear recommendation for you.
Okay, let's get right into it then. Our source material describes AAL as high-leverage turnaround play. What does that even mean for an investor, and why is this particular company such a point of contention among analysts?
Right. So at its core, American Airlines is a company operating on a very fine line financially. The sources emphasize its precarious financial health. It's burdened by what's called an industry-high debt load and even negative shareholder equity. Now, this is highly unusual for a public company. It signals significant financial fragility. Essentially, their total liabilities exceed their total assets, which for many investors is an immediate red flag.
Yeah, negative shareholder equity sounds pretty alarming, frankly. So why would anyone even consider investing in a company like that? This feels like the key to the whole puzzle, doesn't it? Can you unpack that aha moment for us? Where despite these challenges, our sources hint at disproportionate value being unlocked.
That's the core paradox right there.
Yes.
While the substantial debt and negative equity translate into, elevated risk and a valuation discount, that very same leverage means that any successful debt reduction or maybe an improvement in margins could lead to disproportionate value for equity holders. The analysis describes the stock as a highly leveraged call option on the enterprise's recovery.
A call option.
Yeah. Think of it like this. If you have a very, very small slice of pie, right?
Yeah.
And the rest of the pie, the debt suddenly shrinks. Your small slice can rapidly become a much larger proportion of the whole pie. The less debt there is, the more of the company's value flows directly to shareholders. That's where the exponential potential comes in.
Okay, I get that. But before we dive deeper into this financial tightrope walk, we probably need to understand the company itself better. What kind of airline is American Airlines? How do they actually, bring in revenue?
Sure. American Airlines is one of the big three U.S. legacy carriers. They operate a vast hub-and-spoke system.
Right.
They fly approximately 6,800 daily flights to nearly 350 destinations globally, so huge scale. Their core business, of course, is transporting passengers. That makes up about 92% of their total revenue. That includes ticket sales, naturally, but also ancillary fees like baggage, seat selection, that kind of thing.
Right. And then they have a small cargo revenue. It's just 1-2%. But this other revenue segment, specifically the AAdvantage loyalty program, sounds particularly important. It's about 7% of total revenue. Is that really as significant as the sources imply? Or is it more of a niche detail?
Oh, it's absolutely critical. Not niche at all.
Yeah.
The AAdvantage program is a critically important and high-margin contributor. The AAL generates significant revenue by selling AAdvantage miles to third-party partners, most notably Citi, for co-branded credit cards. In fact, there's a new 10-year agreement with Citi starting in 2026, and that's expected to be a significant driver of future value, precisely because of its high profitability and its stability. Unlike the more cyclical nature of ticket sales, right? It's a truly valuable, almost recession-proof asset for them. And they're also a founding member of the One World Alliance, which extends their global reach, lets people travel seamlessly across carriers.
Okay, so a global airline, valuable loyalty program, but operating with this massive debt. Let's zoom out a bit. Our sources say the airline industry itself is profoundly cyclical. What does that mean for AAL specifically, given its situation?
Well, the industry is mature. It's highly capital intensive. Think expensive planes, leases, maintenance. And it's marked by intense price-based competition, always fighting over fares. Demand for air travel is discretionary, meaning it rises with economic expansion and contracts sharply during recessions. People cut back on travel first. Now, this cyclicality is magnified because airlines have high fixed costs, things like aircraft leases, labor, airport fees. Those costs don't go away easily. That's operational leverage. And for AAL specifically, having that industry-high debt adds financial leverage through substantial fixed interest payments. So you have this dual leverage, which creates a powerful multiplier effect. Small revenue changes can lead to huge profit swings, up or down, because those fixed costs and debt obligations, they don't just disappear when revenue dips.
Wow. So yeah, if the broader economy just sneezes, AAL seems like it could catch a full-blown flu, maybe even worse. The sources specifically mention AAL stock exhibits a high beta, consistently measured above 1.0, placing it at 1.43. What does that tell us? What should we expect from this stock's movements?
A beta of 1.43 means the stock is expected to be 43% more volatile than the broader market, like the S&P 500. It's a direct consequence of that high operational and financial leverage we just discussed. It amplifies everything. It's exactly why the stock has a boom or bust investment profile. You should expect it to swing much wider than the S&P 500, both up and down. During periods of market movement, it's going to be exaggerated. It's certainly not for the faint of heart.
And the industry also has predictable seasonality, right? Driven by leisure travel. Peak profits in Q2 and Q3, summer holidays,
Yeah.
and then weaker shoulder seasons in Q1 and Q4. That just adds another layer of complexity, doesn't it?
Absolutely. It means the cash flows aren't perfectly smooth throughout the year. They need careful planning to manage capacity, promotions. It's a constant balancing act for them.
Okay, let's get into the specifics then. The financials. Our sources show a pretty stark picture. Staggering net losses. Nearly $9 billion in 2020, $2 billion in 2021, obviously the pandemic, then a return to marginal profitability by 2022. What does this tell us about their recovery trajectory beyond just, surviving?
Well, the recovery in revenue has actually been robust, surpassing 2019 levels, which is good news, driven by all that pent-up travel demand, however. Profit margins remain thin. They're pressured by rising labor and fuel costs. So this highlights the challenge, right? Translating that strong top-line revenue into strong bottom-line earnings. They're making money again, but maybe not as much as you'd expect given their sales growth.
And that balance sheet, the massive debt load, and that negative shareholder equity we keep coming back to.
Yeah.
How has that evolved, and what's the plan? Is there a credible plan to fix it?
Yeah. The company took on a monumental amount of debt to survive the pandemic. That's what pushed equity deep into negative territory, where it still is today. Management has made debt reduction a top priority. That's their mantra now. They're aiming to reduce total debt by $15 billion from its mid-2021 peak. And the good news, the really crucial part, is they've been generating positive free cash flow since 2023. That's about $1.563 billion in the trailing 12 months, the TTM. This positive free cash flow is, well, it's their war chest. It's crucial for funding necessary capital expenditures like new, more efficient aircraft, and most importantly, executing the debt reduction plan. This free cash flow is truly the engine of their potential turnaround. Without it, there's no story.
Got it. Not applicable or analytically meaningless for AAL because of that negative equity. So if these key metrics are kind of useless here, what should we be looking at instead? What tells the real story?
Yeah, you should absolutely ignore those ratios in this specific case. They just don't work mathematically or logically with negative equity. For instance, a positive net income divided by negative equity gives you a negative ROE, which is just misleading. Instead, you need to focus on absolute debt levels. How much debt do they actually have? Is it going down? And look at ratios like debt to EBITDA. That gives a clearer picture of their leverage relative to their operating earnings. And importantly, as we just noted, track their free cash flow, or FCF. That $1.563 billion in the TTM is a very positive signal for their debt reduction efforts. That's key.
Okay, so with all this context, what's the actual investment thesis for American Airlines? This is where that sharp confrontation of ideas really comes to light, isn't it? It sounds like very strong arguments on both sides.
Exactly. The sources frame the investment thesis as a speculative turnaround. And yeah, it really is speculative. Let's break it down. The bull case. This is predicated on the potential for significant equity value appreciation as the company directs free cash flow toward reducing its substantial debt load. That's the core. The key insight, the aha moment for the bulls, is that each dollar of debt retired disproportionately benefits the small negative equity base. potentially leading to an exponential increase in share price. Remember that coiled spring analogy?
Right, the spring ready to release energy if the debt pressure comes off.
Exactly. If they succeed in deleveraging, the existing shareholders benefit massively because their small slice of the pie gets much bigger much faster.
Okay, I definitely see the argument for optimism there, that potential explosive upside. But what about the other side of the coin? What's the strong counterargument, the bear case that highlights all those significant risks?
The bear case. This is anchored in the fragility of this same balance sheet. It's all about the risk. It exposes the company to existential risk in the event of a severe recession or a sustained spike in operating costs. If they can't manage the debt, or if another external shock hits like another pandemic, unlikely maybe, but a deep economic downturn is plausible, the entire house of cards could fall, potentially leading to bankruptcy. The margin for error here is incredibly thin. It's like playing a high-stakes poker game where one really bad hand could wipe you out completely.
So what are the key catalysts the bull case relies on? What needs to happen for that coiled spring to finally release?
Successful deleveraging is undeniably the most powerful potential catalyst. That's number one. It directly reduces risk and increases equity value. Margin expansion is also crucial. That could come from moderating fuel prices, maybe better cost control, getting more efficient. And then there's loyalty program growth, especially from that new city agreement kicking in 2026. That's a stable, high-margin revenue stream that helps.
And on the flip side, the biggest threats. What keeps the bears up at night worrying about AAL?
The economic recession is definitely the single greatest threat, no question. Any significant drop in travel demand would be catastrophic, given their fixed costs and debt. Fuel price volatility is another huge one. Jet fuel is just a massive, largely uncontrollable expense for airlines. Intense competition in the airline industry always pressures pricing, limiting how much they can charge. And then there's labor relations. Unionized workforces can demand higher wages or even lead to costly strikes. But really, above all else, the sources highlight the extreme financial leverage as the single most critical risk facing American Airlines. It truly magnifies every single other threat.
Given these completely dueling narratives, how do the valuation models try to reconcile this? Our sources use both a discounted cash flow, or DCF, model and relative valuation. What do they find?
Okay, so the DCF model, which projects future free cash flows and discounts them back, it estimates an intrinsic value of $16.50 per share, unquote. Now, a sensitivity analysis shows it could go higher or lower based on different assumptions about growth, costs, etc. But importantly, it suggests that under a reasonable set of assumptions, the stock possesses potential upside from its current trading level, meaning based purely on its potential future cash generation, it doesn't look wildly overvalued right now.
Okay, potential upside based on cash flows. But then there's the relative valuation, comparing it to peers like Delta and United, and that showed a clear dichotomy. This is where it gets really interesting for understanding the market's perception, right? Almost like the market sees two different companies.
It is fascinating, and this is exactly where that paradox we mentioned becomes crystal clear. On a price-to-sales PS basis, AAL appears significantly undervalued. It trades at just 0.16x sales. Compare that to Delta at 0.63x and United at 0.56x, so way cheaper based on revenue. But this discount is the market's way of pricing in the enormous risk associated with AAL's balance sheet. The market isn't stupid, it sees the debt. However, if you look at the enterprise value to EBITDA multiple, the EBITDA multiple, which includes debt in the valuation, AAL trades at 7.0x, which is actually comparable to or even slightly richer than its peers.
Wow. So what does this valuation paradox ultimately mean for us, for you listening, trying to understand this complex issue? It's like the company is cheap on one metric, but definitely not cheap, maybe even expensive on another. How do we square that?
It means the underlying business operations, the airline itself, isn't necessarily cheap when you factor in all its debt. You have to include the debt. The cheapness you see on a price-to-sales basis is a direct reflection of the very high financial risk. So the investment isn't just buying an airline business, it's more like betting on the equity itself, representing a highly leveraged call option on the total enterprise value. You're betting that management can successfully improve earnings and reduce debt. If they do both, the value flowing to that tiny negative equity base can indeed increase exponentially. Taking both valuation approaches together, the sources synthesized a fair value range of $14 to $18 per share over the next 12 to 18 months.
Okay, so after digging through all of this, the debt, the potential, the risks, the valuation paradox, what does it all mean? What's the final verdict from our sources for listeners trying to make sense of AAL?
The recommendation is hold for a 12-month time horizon.
A hold. Not a buy, not a sell. Given how extreme the bull and bear cases sound, why land on that neutral ground? Why not take a stronger stance?
Well, the justification is that the current market price appears to fairly balance the significant potential upside from a successful deleveraging against the substantial risks posed by the company's balance sheet and the uncertain macroeconomic environment. It's saying the market price kind of reflects this tension already. There's also near-term uncertainty mentioned coming from moderating domestic travel demand and those ongoing cost pressures we talked about. Those things temper the bullish enthusiasm right now. So it's basically a recognition of the very fine line the company's walking. The risk and reward feel balanced at this price.
Okay, so for investors out there who already own AAL, maybe those with a higher risk tolerance, the advice is essentially to maintain their position because the potential reward from a successful turnaround could still justify holding on. But what about new investors, people listening now thinking about getting in? What's the advice for them?
For new investors, the sources advise caution. They say to wait for a more attractive entry point or confirmation that cost inflation is under control. It really boils down to prudent risk management. Wait for clear signals that the company is truly accelerating its debt reduction and effectively managing its costs. Don't jump in blind. And this raises an important question for you, the listener. Are you comfortable with this level of volatility, this boom or bust profile, for the potential upside? Or would you prefer a more de-risked opportunity, maybe something where the path forward is a bit clearer, even if the potential gains aren't quite as explosive?
What an incredible deep dive. Seriously fascinating look into airline investing, financial leverage, and just navigating a truly complex investment scenario. We've really seen how a company's debt can turn it into this high-wire act, where success could mean exponential returns, but failure carries such significant risk. That valuation paradox and the idea of AAL as a highly leveraged call option, those concepts really stick with you, don't they?
They really do. American Airlines is just a prime example of why understanding the why behind the numbers is just as crucial, if not more crucial, than the numbers themselves. And that strategic decision to recommend hold is really a testament to the finely balanced risks and rewards here. It requires patience and a really watchful eye on that critical deleveraging process.
Well, thank you for joining us on this deep dive. If you found this discussion valuable and you want to stay ahead of the curve with insights like these, make sure you subscribe to the deep dive. You'll get the fastest and most frequent updates that way. Until next time, keep digging into the details because that's where the truly interesting insights lie.
And remember, even in industries that seem stable on the surface, like airlines, the financial structures underneath can create entirely different investment profiles. Keep asking those critical questions.